The balance sheet illusion. In early 2019, the multinational conglomerate Ardent Global Manufacturing was riding high on Wall Street. The company's quarterly earnings report boasted record profits, a surge in share price, and an ambitious plan to expand its production facilities across 3 continents. But behind the shimmering numbers lay a void, a carefully crafted illusion. The illusion began with a single missing ledger entry. During a routine vendor reconciliation at Ardent's Midwestern plant, a junior accountant named Elena Ross noticed a $4.2 million payment to an offshore supplier that didn't exist in procurement database. When she flagged it, her manager brushed it off as a timing difference. Yet the payment reappeared the next quarter under a different vendor name. Elena escalated her findings to the internal audit department. Within days, the matter landed on the desk of David Klein, a senior forensic auditor contracted by the company's legal counsel. Klein had spent 2 decades tracing corporate deception, from shell entities to false revenue recognition schemes. But even he wasn't prepared for the depth of what he was about to uncover. The first red flag: overstated assets. Klein's team began by reconciling Ardent's consolidated balance sheets against physical asset reports. They discovered inventory inflation across multiple subsidiaries, $280 million in machinery and parts that no one could physically verify. The trail led to a warehouse in Delaware that existed only on paper. Digging deeper, the team found that these phantom assets had been used to secure credit lines worth hundreds of millions of dollars. The funds were diverted through a network of offshore accounts in the Cayman Islands and Luxembourg. The illusion was deliberate. The company's CFO, Martin Rhodes, had quietly built an empire of shell subsidiaries to move funds undetected. Each entity was registered under a slightly altered name: Ardent Global Holdings, Ardent Manufacturing Limited, Ardent Industrials LLC. Together, they formed a spiderweb of transactions that concealed a growing cash deficit. The cover-up, as the forensic team compiled evidence, resistance grew from within. Emails disappeared from the company server. A subpoenaed database was found corrupted. 2 auditors reported being followed after work. When David Klein requested direct access to the CFO's private ledger, the company's general counsel abruptly terminated his contract. That same week, Ardent CEO announced an internal review, claiming procedural misunderstandings had created discrepancies. Investors were assured that all was well. But Klein's team had already secured backups of the deleted emails through the company's cloud archive, including one critical chain. In it, Rhodes wrote, "Ensure the auditors are given the sanitized balance sheets. I'll handle the external confirmations myself." The message was dated 2 days before the company's annual report filing with the Securities and Exchange Commission. The forensic breakthrough. Working under federal subpoena, Klein's team coordinated with the FBI's Financial Crimes Division. Through digital forensics, they traced $612 million in misappropriated funds routed through dummy vendors linked to the CFO's family trust. The evidence was overwhelming. Forged invoices, duplicate ledger entries, and falsified audit confirmations sent to Ardent's external auditors. When agents raided the CFO's private office, they found an encrypted drive containing what he called the master sheet, a file documenting 5 years of manipulated financial statements. Each entry was color-coded to show which subsidiaries had participated in the fraud and which executives had authorized them. The scandal broke in national headlines as the balance sheet illusion. Ardent's stock price plummeted by 70% within a week. The board dissolved. Investors filed class action lawsuits. Martin Rhodes was arrested and charged with wire fraud, conspiracy, and obstruction of justice. Several executives entered plea deals, but the damage extended far beyond the boardroom. Thousands of factory workers lost their jobs as subsidiaries collapsed under debt they never truly owed. Pension funds evaporated. Forensic auditor David Klein testified before Congress, warning, corporate transparency isn't just about numbers. It's about trust, and once that's gone, no audit can restore it. Months later, during court proceedings, prosecutors discovered that one of the external auditing partners, a respected figure from a Big Four firm, had approved the falsified reports in exchange for offshore payments. The revelation sent shockwaves through the financial world. It became clear that this wasn't the work of a rogue CFO alone. It was a systemic conspiracy involving auditors, executives, and even mid-level staff who looked away. Ardent Global was liquidated. Its remaining assets were sold to repay investors. But the real loss was public confidence in corporate audits. The moral and call to action of the story. Corporate integrity is not built in spreadsheets. It's built in conscience. Every falsified ledger, every forged document, every silenced whistleblower chips away at the foundation of public trust. Transparency must never be negotiable.